Today's bond market took a serious tumble after a 7-year auction from the Treasury fell short of expectations. Peter Tchir joins us from Academy Securities, the head of macro strategy. So Peter, should investors be alarmed by what happened today in the bond market?
I don't think so. I think yields are backing up. It's partly due to expectations that inflation are going higher. I think people are missing how, tight the Fed is going to behave. So the Fed is not going to tighten, right? The Fed's going to keep to this easy monetary policy. So I think it's a little bit overdone. But also, if you look at where stocks are, S&P is barely off its all-time highs, right? We were with 10 points of the all-time highs yesterday on the S&P 500. So this is much more about the NASDAQ and some, select kind of cult stocks that I think are just feeling the pressure, and probably rightfully so.
I hear you on the valuation compression there, but Peter, it feels like there could also be a really great bull case that's not shaping up right now, which is that if investors are going to pull their money out of bonds, where are they going to put it? It seems like they're not going to put it in the stock market, at least not immediately.
I think it will go to the stock market, right? Everyone's just adjusting. I think people have been very complacent on the equity side, particularly in those cult stocks. They kind of view them as almost too safe. So people have to readjust their risk perspective. But when all is said and done, we're going to get two messages out of this. A, the Fed is not going to tighten. The Fed is going to remain with easy money. And yields are going higher because we are going to get significant spending, both on the current stimulus bill, which doesn't excite me very much, but we're going to move on to infrastructure spending. So we're going to see real economic growth domestically and globally. That's why yields are having trouble, but that should ultimately translate to positive for most stocks.
Okay. So how much of the thesis for the market going forward, Peter, depends on the trend in the 10-year yield? Because it seems like we could kind of keep going in circles where, okay, they're going to take the money and put it in the stock market, but then the expensive stuff, the stuff that's been working, we should add, it's not just GameStop, right? I mean, forget all that. Right. I mean, this goes down to big tech too, and these expensive companies in the tech space that did great during quarantine. So if they're taking the money out of those because yields are going up, but they're going to put the money they took out of yields or took out of bonds into the market, but then they don't put it into those stocks, does that mean that our stock market doesn't quite go up as quick? Does it mean it goes to the side? Or do you think they're going to put it back in and the frothy stuff's going to keep running?
I think it's going to go into other areas. So I love commercial real estate, for example. I've liked it for a while. It's had a nice run. I think that's going to continue, right? This realization that, hey, we are going to go back to something that resembles normal. I love airlines, leisure and travel. I think all of that is going to be the beneficiary. They've already run up significantly. I think they have more room to run as people adjust to it. And that's where people are underweight. That's where people aren't fully exposed. Energy's been partly underexposed too because it was so out of fashion with ESG. And a lot of these energy companies are going to find ways to embrace ESG. So those are the sectors that are going to benefit. So I think you've got to be very careful. And even when we talk about the markets, right? The Dow, which I hardly ever look at, but the Dow performs very differently right now than the S&P, which performs differently than the NASDAQ, which performs differently than the NASDAQ 100. So this is really about rotation within sectors more than we've seen in a long time, and I think that's going to continue.
Okay, so rotation here being very important, right? And then we'll see how the math adds up basically for the amount of money that goes into the rotation stocks, the new leaders, versus the money that gets taken out for the old ones, and whatever that sum is, will decide where the overall market goes. So specifically what you're saying here is there are areas that are not part of this valuation compression that you want to be in. Peter, we were talking with this about with Ed Klissel at the top of the show too a little bit, is if this rotation happens so severely though, and this bond move is not just a day, does everything eventually get wrapped up? Should one be prepared for even those value companies to go down too?
I think you could see some of that, but again, if yields are really going higher because of inflation, you should see money flow into dividend stocks, for example, right? Dividends can compete with inflation. So there should be sectors, and I really believe that the Fed is committed to driving unemployment down to, say, 3%, right? The Fed has changed its mandate, it's changed its view of how inflation is created, how we live with inflation. So I think some of what's happening today is people reacting to the mentality that the Fed used to have. I think over the coming days, we're going to get clear message from the Fed that this is a new regime. We are going to live with inflation, especially if we think it's temporary. We are going to do everything we can as a Fed to drive unemployment down to 3%. That should calm markets. So I watched the 5-year Treasury. Today, the 5-year Treasury and that 7-year auction were more important than what was going on in the 10-year. I think the Fed will come out in the next day or two saying things that soothe the market there, which allows the risk-on type rally to go back. But again, it's going to be away from some of these cult stocks that I think have run out of steam and are under pressure where people are now facing some losses.
So, Peter, here's the thing that still is is awkward for me is we keep having this conversation, investors, about, well, the yields are, they're repricing and we're moving forward and Powell's not going to hike. To me, the more I think about it, that's why they're selling off. Because if he's not going to hike, then we know he's not going to stamp out the economy and its recovery like was a risk in the past. So the risk of the counteracting force for the economy is no longer there, which means at some point now or in 50 years we're going to get inflation. So I'm just going to keep selling my bonds. So how does this not resolve itself in just a more spikes like this until they control the yield curve?
I think they're going to continue to work on controlling the yield curve. And that's why, though, I really want to watch the 5-year, because the 10 and 30-year can float a fair bit. It's going to move around based on where the market views it. That 5-year, when that started moving, that tells me that people are starting to bet that the Fed is going to have to change their mentality, right? Okay. So the 5-year and in is really more directly tied to the Fed. That's what kind of drove today's move, in my opinion. And I think that's what the Fed is going to try and address and say, hey, don't worry about that. And it really doesn't matter that much where 10s and 30s drift. And people really have to pay attention that every corporation, I think, that had the opportunity last year to issue a lot of long-dated, cheap debt, and they did. So it's not going to translate to that. People refi their homes, so higher yields are not going to be an instant drag on the economy at all.
Okay, Peter, so not a drag on the economy, maybe a bit of a drag on parts of the stock market. What are your thoughts on what we should expect from Powell in terms of where his threshold is to start doing a yield curve control? Is it going to take a market sell-off? Is it going to take yield at a certain point? Do you expect Powell to be responsive if stocks keep coming under pressure?
Yes, but I think before they actually do anything, we haven't even really seen the proper job owning, right? The Fed would like to job own this. A couple things that they can do right now would be talk about some sort of Operation Twist. There is actually, bizarrely enough, some pressure at the front end of the yield curve where there's actually a shortage of bonds necessary for a lot of technical reasons. So it might be really interesting to see if the Fed starts contemplating or thinking out loud about an Operation Twist where they would sell the front end, T-bills, 6-month paper, to at the other end buy more long-dated bonds. So they could try and address that in that form. They could talk about shifting their regular buying, where they're shifting, and they can remind people that yield curve control is something they can talk about. They would never do it out the curve right now. I think they'd talk about 2-year or 3-year, but the market would immediately respond to that. So I'm looking for job owning rather than action, and I think that job owning comes out fairly soon. Okay.
All right, Peter, thanks for jumping on with us. Needed an emergency call here with Mr. Tchir. Thanks a lot.
Thanks
Head of
for having
Macro
me.
Strategy. Yes, sir. At Academy Security.